All right. Good morning, everyone. We are Group 3, and we will be discussing about the exercise number 5 or the chapter 5. Let me just fix my screen here. Okay.
Okay.
So, variable and absorption costing unit product cost. It has Ida Sidha Karya Company is a family-owned company located in the village of Gianyar on the island of Bali in Indonesia. The company produces a handcrafted balanced musical instrument called the gamelan that is similar to a xylophone. The sounding bars are cast from brass and hand filled to attain just the right sound. The bars are then mounted on an intricately hand-carved wooden base. The gamelans are sold for 850,000 rupiahs. The currency in Indonesia is the rupiah. So the denomination is RP. The following are the selected data for the company's operation last year. Units in beginning inventory, 0. So I'm assuming this is their first year. The units produced 250. Units sold 225. Units in ending inventory 25. Variable cost per unit, direct materials would be 100 rupiahs. Direct labor 320. Variable manufacturing overhead 40. Variable selling administrative 20. For the fixed cost, we have manufacturing overhead of 60,000, selling and administrative of 20,000. So that would be our given. So this is the required. Assume that the company uses cost for one gamelan. The other one would be the company uses variable costing. Then we will also be computing for the product cost of one gamelan. So we have it here. Absorption costing in the first column and the variable in the second one. Direct materials would be 100 both. Direct labor 320 both. Variable manufacturing overhead also considered or taken in consideration for both. And for the fixed manufacturing overhead, it only appear on the absorption costing. So that will be a total of $700. Oh, sorry, 700 for the absorption costing and 460 for the variable costing. So, okay. Variable costing income statement, explanation of difference in net operating income. Refer to the data in exercise 5-1 for Ida Siddhakarya Company. The absorption costing income statement prepared by the company's accountant for last year appears below. So ito yung parang um, normal na income statement. So ito yung required. Determine how much of the ending inventory consists of fixed manufacturing overhead. Cost differed in inventory to the next period. Second would be prepare an income statement for the year, pero this time we will be using the variable costing method. So explain the difference also in the net operating income between two costing methods. So first, we need to determine how much of the ending inventory consists of the fixed manufacturing overhead costs differed in inventory to the next period. So we first divide the fixed manufacturing overhead to the units produced to get the fixed manufacturing overhead per unit. That would be 60,000 divided by 250. That would be 240 rupiahs per unit. So now, knowing that on the last given that we saw, there are 25 units in the ending inventory, and the problem requires us to know what is the uh, what do you call this one? How much of the ending inventory consists of fixed manufacturing overhead. So we will be multiplying the fixed manufacturing overhead per unit for the remaining ending inventory, and that would be 6,000 rupiahs.
Right.
So here is the second requirement on the problem. So income statement using variable costing. We already saw the absorption costing income statement a while ago. Now this is the other one, which is using variable costing. So that is our sales, 850 times the unit sold. So beginning inventory would be 0, as we see on the given. Cost of good manufactured would be 250, and the given also a while ago. So that will be our available for or goods available for sale. We add the beginning inventory plus the cost of goods manufactured. So we already have our ending inventory also on the given, so we will just be deducting that to the goods available for sale. Also, so this would be the variable cost of goods sold because we already deducted the ending inventory. Now we will be adding, the variable selling and administrative expense. So that will be 4,500. That is 205 units times 20 rupees. So that will be the, I think, the produced one. Sorry, the sold one. Because it is a variable selling administrative expense, we multiply it to this unit of sold, goods sold. Okay. So that will be 4,500. Add the 103,500 plus 4,500, that will be 108,000. Deduct that from the sales, which is 191 to 150,000. We will be getting the contribution margin of 83,250. Now we will be deducting all of the fixed expenses that we have. We have fixed manufacturing overhead and fixed selling and administrative expense. So that will be 60,000 and 20,000. We get this from the given that we have a while ago. So that would be 80,000. Net operating income would be 3,250. So now, as the requirement of the second part is also asking for the explanation of the difference, we can reconcile the difference between absorption and variable income as follows. Variable costing net operating income is 3,250, the one that we got just a while ago. And then we will just be adding the fixed manufacturing overhead cost deferred in inventory, which is the 25 units times the 240 per unit. That is 6,000, and that will be the missing part to get the 9,250 and match it to the absorption costing of the net operating income, sir.
Okay, correct.
Next, variable and absorption costing, unit product costs and income statements. Lynch Company manufactures and sells a single product. The following costs were incurred during the company's first year of operation. So, meron ulit tayong variable cost and fixed cost dito. Separated na. Direct materials, direct labor, variable manufacturing overhead, $6.93. And selling administrative expense would be 4. Fixed cost per year. For the manufacturing overhead, we have 300,000. Selling and admin, we have 190,000. During the year, the company produced 250 units. So we already have the um
25,000 units.
to 25,000 units and sold 20,000 units. The selling price of the company product is 50 per unit. So with this given, we will be already knowing how much or how many units were left in the inventory, the ending inventory. Because 25,000, we will just be deducting the 20,000 units that were sold. Okay. Assume that the company uses absorption costing. We will be again computing for the product cost using absorption costing and income statement using absorption costing. The other requirement 2A and 2B will also be about, will also be about variable costing, this time using it for the product costs and the income statement for the year. So here is the costing using absorption. We consider the direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. That will be 300,000 divided by 25,000 units produced. Okay, so that will be a total of $30 per unit using absorption costing. Now we do the income statement, and we will be using that one as the multiplier for the cost of good manufactured and ending inventory that we just talked about a while ago. Again, we sold 20,000 units and we are selling them for $50. We will be getting a sales of 1 million. Beginning inventory zero, as this is the first year of the company, as it is stated in the problem. We will be multiplying the 25,000 cost of good manufactured by the 30 um, uh, absorption costing that we got a while ago. That will be 750,000. At the beginning inventory and the cost of good manufactured, we have 750,000 goods available for sale. Okay, we will then be deducting the ending inventory, of course, and it will also use the multiplier of the absorption costing we got a while ago. That is $30. That will be $150,000. Deduct that from the $750,000, we got $600,000. Again, deducting it from the $1 million of sales, we got a gross margin of 400,000. Now we will be deducting or lessing the selling and admin expenses for the variable service selling SNA. 20,000 times $4. That will be 8,000. This is also given on the problem. Fixed SNA expense would be 190,000. Add them both, we have 250,000. Deduct that from the gross margin, we will be getting a net operating income of 130,000. So moving on to the next method of costing, variable costing, we will only be considering the direct materials, direct labor, and variable manufacturing overhead. So that will be $6, $9, and $3. So for the income statement of the variable costing method, again, 20,000 units sold. Multiply that by the selling price of $50. We have 1 million. Beginning inventory again would be zero. Cost of good manufactured. Now instead of using $30 as the multiplier, because we'll be using variable costing, we use the $18 multiplier. That's the what we get in the variable costing that we did a while ago. So that would be 450,000, a total of 450,000 again for the goods available for sale. We'll be deducting the ending inventory of 5,000 units, now multiplying it by $18. That would be $90,000. Variable cost of goods sold would be 360,000. That is the difference between 450 and the 90,000 on the ending inventory. Variable selling admin expense will also be added to get the contribution margin. So that will be 360,000 plus 80,000, 440,000. Then deduct that from the sales of 1 million, we have a contribution margin of 560,000. Now we will be deducting all of the fixed expenses, fixed manufacturing overhead of 300,000 and a fixed selling admin of 190,000, total of 490,000, and a net operating income of 70,000. Though it is not required on the problem, we also added this explanation of the difference between the net operating income of the variable costing and the absorption costing. So we can reconcile the difference between the absorption and variable income as follows. Variable costing net operating income, 70,000, the thing that we got a while ago, just the previous slide. We will be then again adding the fixed manufacturing overhead, cost deferred in inventory, which is the 5,000 units times 12 per unit. So the absorption costing net operating income would be 130,000, matching the one that we have a while ago. That would be all for our report, sir. Thank you so much.
Thank you.